What's your take on the market?
I watched Powell's speech, and it was really amazing because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have 225 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days. Right, so everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that, at least in the next 30 to 90 days. The pain trade is to go up. So that's probably where we're going.
Yeah, and what impact would that have on the market?
I think Sachs is right. I think the marginal risk here is for this whipsawing. So we have a period now which is disinflationary. But the problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. You know, there's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend, because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh, and really?
So the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that we do whipsaw, as Sachs says.
When you say book build, you mean trying to see if you'll get some early takers to buy equity in an IPO, perhaps even in a company like Stripe that's been sitting on the sideline?
So not Stripe, they're in a complicated moment. But when they call to book build, they basically say, hey, listen, XYZ company, quiet filed, look at the S1, what do you think? Where's the price? Blah, blah, blah. And they're trying to get an indication of whether you'd want to be in the IPO book. So I think that there's a lot of those testing the waters that are now starting again.
Would there be an appetite in your mind for an IPO in the second quarter of like a Stripe type company? Putting, you know, I don't know what the other candidates are, the lead candidates, but Stripe is the one people talk about most.
The thing that we have to think about is like, most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. Similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days.
Yeah, I was about to get to that. Yeah.
Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is, what happens if inflation somehow all of a sudden pokes itself back up? Right now, it doesn't look like it is. And Powell was clear, and it's true. We're in a deflationary cycle.
Well, he said deflation 11 times during his, he's
we're in a
very
deflationary
clear
cycle.
about his use of language. Yeah.
That's why the market ripped.
If you listen to Buffett's teacher, this guy, Ben Graham, in Ben Graham's book, the way that he would look at a stock, and obviously, look, things have changed, but the way that he would look at a stock is he would look at that risk-free rate, he would double it, and then the inverse of that is the maximum price to earnings ratio that he would pay for a stock, right? That's the trade-off is if you can get more than 2 times the risk-free rate, then it's worth owning a company. What that means is that if you take 3.5% as a terminal rate, the right PE is around 14 for the S&P 500. Right now, the S&P 500 trades at 22 times PE, which would mean that we are 50% overvalued. Now that, again, that's a Benjamin Graham model, and I think the world has pretty cleanly moved away from it, but there's probably some rooting in that intellectual framework that's still valuable. And to your point, David, it just reinforces that, man, we need to start to learn a new regime here because when rates are not zero, there's just a lot of excess that you can't support because the alternative trade-offs for investors are plentiful, and plowing money into a money-losing startup becomes less attractive.
And to just give people some background, that's The Intelligent Investor was that book, I believe. And he was talking about value investing, which is, hey, what's the earning per share? What's the ratio? What's the PE? And that's something that growth and momentum investing has been the opposite of. And this is could be, I think you wrote a blog post about this, Chamath, sort of the regime change. If you look at the Googles, the Facebooks, the Apples, Amazons is a little bit of an exception here. Those companies printed money. They had profits. They built up large cash reserves. If we look at the next cohort of companies, Airbnbs, Coinbases, Ubers, etc., they focused on the top line growth, much like the Amazon, which was a very obscure approach, correct, Chamath, in the history of this?
Nick, do you want to just throw up this chart? We did a little analysis over here, and it was just basically looking back 60 years of company formation. We looked at all of the 100 most valuable public company startups, and we indexed that to the 10-year interest rate.
So what are we looking at here, Chamath, with this chart?
So basically, we went back from 1960 onwards. So basically, 63 years. And what this shows you is the 100 most valuable public technology companies. Then the size of the circle here is their market cap. And then it's overlaid on top of the 10-year interest rate, as well as gray bars for recessions. So what is this graphic meant to illustrate? Well, it just was for us to study, is there a correlation between the value of companies and what the interest rates were or what the economy was doing at the time? And to your point, Jason, the trend is pretty starkly made on this chart, which is that if you are a company that was founded in a period of austerity, you had the ability in general to build a much larger company than that which was founded in a period of wealth and excess, right? So when you look at when rates were sort of approaching zero or were zero, There was a lot of really successful companies. They're listed here in the light gray on the right, but none of those things really represent the success that these other companies had. That's the first interesting takeaway. The second interesting takeaway, though, from this has nothing to do with rates per se, but it is that when rates intersect with the emergence of huge technology trends, so in the case of the 1970s, it was the PC revolution. In the case of the late 1990s, it was the internet revolution. Those two things, which required enormous progress in both physical infrastructure, so atoms, as well as software infrastructure, bits, when you put those two things together, those also created big companies. And so if you add that all up, the point is that whenever you see huge tectonic shifts in technology combined with periods of austerity, that's when the gargantuan dollars are made. So in the 1970s, companies like Microsoft and Apple from the get-go had to be profitable, right? And in the absence of one very important round of financing that Amazon was able to close, the next big wad of companies were founded again in rising rates where they just had to get profitable or find a way to be positive free cash flow or have positive working capital faster than anybody else. So these are like really interesting trends that I think just say that as rates creep back up, and if we can intersect that with some improvements in technology over the next 5 to 10 years that we've all talked about, it could be a real boon for startups and startup investing. There's a guy on my team sent me this chart. He did a pretty detailed technical analysis of Facebook. Nick, can you please put that image up there? So basically this shows the...
This is really technical.
This is the first time Facebook mentioned the word metaverse. In Q2 of 21, on the earnings call, they mentioned it 20 times. Yeah. And the gray line here is the stock price. So as they kept mentioning it, the stock price just, reacted as it did. But Q4 of 22 was the first time that the word efficiency exceeded the word metaverse. And you saw the stock price rip up. So what's happened at Facebook is really interesting because I think it transitioned to what's generally called an ex-growth company, which means that people are now looking at a business that has essentially gotten to its peak size. And now what they're looking at is its ability to generate cash flow. The cash flow generation or cash flow yield of the business was like 3.5%. But they're making enormous cuts, both in CapEx as well as headcount over time. They're getting their expenses under control. And all of that should drive up their free cash flow yield. And so I think why people got very excited is there are very few ex-growth stocks that you can own that can just compound and crunch ginormous amounts of money. And these guys are in an incredible position to do it, more than $100+ billion of revenue. And if you get these costs under control and get efficient, get the employee base down to 30 or 40,000 over time, this is a thing that just spits out just ginormous amounts of cash. And so it's
back
really
to value investing and Warren Buffett, that means the earnings per share go way up.
Yeah, like the Facebook PE is quite modest actually. Now I actually put back in stock-based comp and its PE is about 11.
So still reasonable.
If you go back to the Ben Graham analysis, this is a company that perfectly meets that criteria of like, you can buy it at a PE that's basically 2 times the risk-free rate. And so I think it's an incredible stock now that you can own. Because if they keep grinding out all of these kind of free cash flow gains, man, they'll just have enormous amounts of money. They already announced a $40 billion buyback. The thing to keep in mind is Apple had a moment like this. And when Apple went ex-growth, they did the brilliant thing, which is they said, we're going to borrow heavily and we're going to return cash. I may have posted this in the group chat to you guys. By 2025, Apple will have exceeded $1 trillion of cash distributions. I mean, that is just nuts.
Does that include buybacks in cash distributions?
Buybacks and dividends. And so Facebook now, you can credibly see a path where Facebook could chunk out hundreds of billions of dollars of total shareholder value returned over the next 4 or 5 years. And so, for value investors, it's somewhat of a kind of a no-brainer. I mean, nothing's a no-brainer, but
yeah,
really, really attractive value fundamentals right now. I think Friedberg is really onto something. And he mentioned this before, so I got curious about this and I went into PitchBook and my team and I looked at all of the people, the humans in our business, that have generated more than $1 billion in distributions on a given deal. And there's 20 that have done that in our industry. Like, there's people that have made hundreds of millions of dollars once or twice, but there's 20 people that have made more than $1 billion more than once, okay? And if you look, not a single one came up through the ranks as a pure engineer or product manager.
Right.
Everybody, to a one, is extremely commercial in their background and their operating experience. Very few percentages of them were actually founders. A huge percentage of them were trained in banks and other places, so non-traditional, quote-unquote, roles for what this current crop of GPs look like, because we went through a phase where if you were a VP of product or a VP of design or a VP of engineering at a well-known startup, that was the most obvious onboarding into a venture firm. But if you just look back at the data, that cohort of people has actually never made money, again, according to PitchBook.
That's fascinating.
And that's a really fascinating counterintuitive takeaway, which is that, and by the way, what's so interesting about that is Pat Grady, I think, had a tweet, and it just sums it up so cleanly because he just hired somebody from Co2. And the tweet was something to the effect of, this guy is the most commercial guy we've ever seen, something like that. And I thought that was so interesting because that is exactly what our heuristical analysis of this data was as well. Commercial people in venture are the ones that make the money.
So you look at a Fred Wilson, Michael Moritz,
Danny
Bill
Reimer,
Gurley.
Bill Gurley, they were investment analysts
I can
in
share you the
public
list,
markets before they became venture investors. Or Mike Moritz, who was an
journalist, yeah. Which is, a journalist is just an analyst. It's another, if you're a good journalist, it's another word for analyst, yeah.
It was really, really interesting looking at that list. So like, there are people in there like Jim Getz, Alfred Lin, Danny Reimer, Jan Hammer, Fenton. So if you look at all of these folks that are just tier one people, and we know all of them, the one common thread amongst all those folks is that unbelievably commercial. And so, Jason, in a moment like this, where you have to really hold the entrepreneur's feet to the fire or be their partner to make extremely hard decisions, you have to have the ability to be respected by them in those moments where you can force a very difficult decision. And then separately, if you have to basically force liquidity so that you prioritize your limited partners, how do you do that while still managing the relationship with the entrepreneur? How do you know that you just need to cut your losses and get out? These are very difficult trade-offs that I think folks haven't been trained in doing. Elon had these guys literally claiming he was running a fraud for years and years, and it was an intense amount of scrutiny because when the stock was less trafficked in, when we were in it in 2015 and 16 and 17, that was the constant refrain, and Elon was constantly batting back folks like this who would make claims. And the way that these guys are allowed to operate is because they use the First Amendment and say, we have the right to say this stuff. I think that shorting falls into two buckets. One is you use it as a hedging instrument. So when we talk about spread trades like long Google, short Facebook, or long Facebook, short Google, you should be allowed to short. I think that's a very reasonable thing to do. I think the question is, if you were on the inside of a company and you say XYZ is happening, for example, Trevor Milton, and it causes the stock to go up and it turns out to be fraudulent, he's held accountable. The question is, should there be the same responsibility for people on the outside who, if they have enough distribution, can say the exact opposite of XYZ is happening? In this case, XYZ is not happening, which then causes the stock to go down, because what the business model of these short sellers is, write a document, it looks very polished and very credible, put on some positions, then put the document out. If the stock goes down, you close it out. In my opinion, I think that short sellers are a really important part of a well-functioning market, or the ability to short. But what I would like to do is take an extra step, which is you should hold these folks accountable the same way you'd hold an insider accountable, which is almost to the effect of like, when you put out this screed, if you make money from it, it should sit in escrow, and the SEC should actually adjudicate whether it's true or not. So in the case of Hindenburg and Nikola, they shorted the stock, they put out a report, it turned out they were right, all that money is completely well earned. Now, what if this Adani thing turns out to be not true? Or true? Nobody knows right now, except 50% of the market cap has already been wiped out. So that's where things I think are in a bit of a gray area. The last thing I'll say is that if you look at the developing world, there's a very gray line between some of the leading entrepreneurs and these governments, because these entrepreneurs are doing the work of some of these governments. whether it's Ike Batista in Brazil in one moment, right, around natural resources, or Adani and Ambani in India, or a lot of the people that have made a lot of money in China, or the people that are making money in developing markets, Turkey, Russia, etc. The government uses very talented entrepreneurs to go and concentrate capital to develop infrastructure progress. We did that in America in the 1800s as well. So that's where I think, you have to also balance it, because his response was basically like, this is an attack on India. And in a way, you can see where he's coming from, right? Because he's building ports and roads and bridges. And he's like, without this stuff, how is India supposed to even exist in the 21st century? That's a reasonable claim. So I agree with you, Freeberg. I don't know whether the report is right or not, but this extra step of actually having the SEC actually tell us what the answer is, I think would be a very important improvement to how this kind of stuff works.
Well, there should also be some rules about the spreading of fear, uncertainty, and doubt. That FUD that happened with Tesla Q, I mean, paradoxically, thousands of
that's
anonymous
an example,
accounts.
That's an example of people essentially lying in public to try to get the stock to move. And Tesla's not a fraud; that's a real company.
I mean, they were winning car of the year while this was going on.
But there was a real human cost to that company, right? To employees that got spooked, to partners that may have gotten spooked. Yeah. The pressure, we saw this, the pressure on Elon in those periods of time. And he was like on the knife's edge, where there was the potential where the company may not have been able to finance its cash flow needs because of those Tesla Q guys. And so it's not to say that the Tesla Q guys can't say it, but they should be forced at some level to prove it if you can create crazy stuff. I posted a link, by the way, for anybody that's interested in reading this. There's a person called Carson Block who's being investigated.
Yes.
Because he may have pushed the boundaries of how short sellers do this. It's a really fascinating read in The Atlantic for anybody who wants to read it. But this is sort of where the short selling thing can a little bit go awry. And it's the title of this is The Man Who Moves Markets. And it's quite a really interesting read if you're interested in how all of this stuff works.